Welcome, everyone, back to episode 78. Hopefully this one's a good one. In the last 77, I heard we had a little bit of rough recording, so hopefully we get the things cleaned up here.
It wasn't Lucky Sevens.
It wasn't Lucky Sevens, but this will be an extra special episode.
Yeah, extra special.
So, Keith, I'm hosting. We got Lisa, Kyle. We're ready to roll. This should be a good show.
Mm-hmm.
So we got a lot of interesting hot topics. That's what I'm going to call the show, Hot Topics. Well, before we get to the hot topics, let's do the old truth, and a lie. We're going to talk about market caps. That's certainly been in the news recently. Apple's had a monster rally here in the last couple months, and it's not quite the largest name in the S&P 500, but certainly getting there. So let's start the two truths and a lie on market caps. Apple nearing $4 trillion in market cap. The 10th largest market cap companies are over $24 trillion when you add them all up. Something to think about. B, the weight of the top 10 is 35% of the market cap of the S&P 500. Or C, at the end of 2022, the top 10 names were 24% of the market cap of the S&P and $8 trillion in market cap. There you go. Those are your options, ladies and gentlemen. Well, we'll let ladies go first. Lisa, what?
It's always me first.
No, I'll make sure next time I host, I put Kyle on the hot spot first.
Sure. Apple nearing $4 trillion in market cap. I can see that because Microsoft and Apple, NVIDIA was always in front, and Microsoft and Apple always take give and take from each other.
Yeah.
So I can see that the 10 largest, 24 trillion seems reasonable.
Throwing a lot of numbers at you, so it
Yeah,
could be
right.
a little.
B, 35% of the market cap of the S&P is a top 10. That is correct. C also seems reasonable. So at the end of 2022, I would say you've done something to C. So C is the lie.
Okay.
But it can be anything, to be honest. It's a percentage up or down. Who
All
knows?
right. Kyle?
I'm going to just split the difference and take A as the lie.
A is a lie. Apple nearing $4 trillion. I tell you what, both you two.
It's not the Apple. It's
we need
the
you.
second part of it.
Oh, okay. So it is. I'm going to have to bring Tyler back here to straighten you two out. Both are wrong. Those are true.
Oh, really?
Really?
So
So
let's,
B is
we'll go through we'll go through these facts. Apple is nearing $4 trillion market cap. True.
Yeah.
Kyle's correct on that part of it. The 10 largest market cap companies are $24 trillion. That's a big number.
That's why I thought that
That's crazy.
it
isn't
seemed like it was too high.
too high, but it's you start thinking
That's
it's
correct,
yeah.
right, yeah.
So anyway, then B, the weight of the top 10 is 35% market cap of the S&P. It just crested over 40. Isn't that crazy?
That was it.
Wow.
It's just that one surprised me. I knew it was up there,
That's,
and it's
it's big.
Yeah.
and then at the end of 2022, the top 10 again 3 short years ago was 24%. So they've gone 24,
had a
and the
rough
market
year,
cap of
yeah.
$8 trillion.
Yeah.
So that's $8 trillion.
And I thought that is too low because even tech had a rough year in 22. I thought it's probably more than that. But yeah.
Lisa can on the bonus question. Don't look. Can you rank at least the kind of a rank order of the top 10?
Is that the right rank?
Yeah, that
here?
don't
Oh.
read. So what do you think without looking again back at the
Yeah,
list?
NVIDIA is the largest.
Yeah.
Then Apple.
Yeah.
Microsoft.
Yep, those two have been flip-flopping, so you're correct on that.
Right. Then we have. Now it's getting tough.
Kyle, can you oh, he's looking at the
No,
list
no,
right
it's
now.
getting-
Oh,
no, it's
geez.
getting tough.
I should have asked him
said.
instead of putting you on the spot, Lisa.
Yeah.
Kyle, do you know what the next ones are?
I would say Amazon.
What did you get through?
NVIDIA,
Yep.
Apple, Microsoft, the first three.
Yeah.
And then I would suggest Amazon next. Or Meta. I don't know.
I think it's Google.
You think so?
And then Meta's. Well,
It
I
is
think it's
Google.
Google.
I'll let you get on it. It is Google, huh?
Microsoft, Meta.
No, Microsoft is number 3.
Microsoft is 3.
Oh.
We determined that. Now we need number
Google,
4.
Meta.
Can you name them? Don't even have to get the order now. Now can you name the 10?
Ooh.
So you've had 4 or 5 there. Who else we missing?
Was JP Morgan in there?
Broadcom.
No, it was though. No.
Broadcom.
Yes. O to Tyler again.
Oh, we need to maybe rank that a little bit higher up then.
Yeah. Actually, that one's if you scroll up now you got me all messed up. It's Broadcom, I think it was like 7 now. It's
Oh.
crazy. Tesla,
Berkshire,
Berkshire,
Walmart's in
and
there.
Walmart.
Okay.
Walmart's the only one that's sub $1 trillion of that list of 10,
Okay.
which kind of surprised me. It's 850.
I would
billion.
have Microsoft, and then is Google. I would have put Amazon there.
Point being is that's crazy. Just if you go back, other decades, you see the largest name in the S&P 500, 2, maybe 3%.
Yeah.
These are now 8s and 7s
Yeah.
and 6.
Yeah.
It's something to keep an eye on. We always talk
What
about
is
market
Walmart? Is
broadening
it in
out.
the 1% range?
It's like 150 or 170. So it's
That makes sense.
yeah, but those are something that obviously we want the market to broaden out, but 40% of the market's tied to these names, so we want them to continue to do well. So I thought that was kind of an interesting stat. All right. So now that we know the top 10 make up $24 trillion, 40% of the market, what do you guys think in the next, we've seen almost a doubling of that in the last 3 years. What do you think in the next 5 years that they could go up again that much? Or Mr. Kyle, what are your thoughts on that?
Yeah, I mean, looking at the top 10, I just think about passive fund flows. I think we were talking about this last week or 2 weeks ago.
Yeah, a couple weeks.
You think about all the 401k assets, all the dollars that are going in blindly. People don't really know what they're buying. And you think about the volume and the overlap that goes into a SPY or a VOO or a, you name it, the S&P 500-esque institutional mutual funds and ETFs out there. And that adds for a tremendous tailwind
yeah.
for these companies. And that probably explains why Walmart is a big beneficiary. And it's almost like a network effect. Once you start scaling, you're just going to continue to scale unless...
As long as dollars are coming in, right? 'Cause
Correct.
You could have the same opposite impact.
Right.
We get into the period where dollars flow out.
Target.
Yeah.
I mean, same kind of thing. So unless it's almost like the tide comes in and lifts all, floats all boats. So I think that's going to be a tremendous tailwind as long as you continue to see corporate earnings do what they do, and that is, continue to grow. So I could see them growing, continuing that.
At least you don't think there's a mark where what are your thoughts on that? Is there a mark that we get to like 50%? Like, geez, 50% they can't.
I mean, it is concerning though, right?
It is.
Because
That's
it's like 40%. That's
10 names.
And then 490 names are like the rest of it, right? I think, can it continue? I think yes. But we have to see, and we are not in the midst of earnings season. One of the big boys is reporting today after close, which is not included there, but the first tech name, which is Netflix. Then Tesla, which is part of the Big 10, is reporting this week as well. So we get the first glimpse there. And I mean, you can see it from earnings season to earnings season, how the expectations just grow even more and more compared to the rest of the 490, right? Where expectations kind of are, not making sense sometimes anymore. And at some point, there will be a time where they cannot fulfill that anymore. And then what happens, right?
Yeah.
So I think they can continue to do well. I mean, we saw that over the last couple of months and years. There's not really competition for them at this point. They have the cash.
Yeah, they cash flow. That's one thing they do.
To do all of that. The thinking is more, will they be able to meet the expectations? Will expectations be a little bit more coming down or be a little bit more reasonable? And what is the rest of the market doing, which can also help for the rest of the market, kind of getting back into the game and taking a little bit of the pressure off the plate for these big names.
Yeah.
I do wonder if, just putting on my Wayback Machine hat and thinking about like the GIC sector split, they broke out.
Yeah, they broke out because other you had comm service in there.
Right. Comm service didn't exist. It was telcos. Yeah. And then they merged media and kind of
some other
agglomeration of stuff. The other thing they did too over time was they pulled REITs out into their own, sector from financials. And so I do wonder if, this dynamic continues to unfold, that you actually see the structure of those indices and how they're actually configured being adjusted by the index provider. So you'd see S&P,
Break
you'd
things
see
up again.
you'd see them potentially say, we're going to break out a mega cap index where it's 25 names, 20 names, 50 names, whatever it is. And then just like you have the Russell 2000 that's small caps, or the S&P 600, 400 for small and mid.
Yep.
I do wonder if that would change that passive flow dynamic, which
Could.
Possible.
Yeah. No, the GICs, just so you know, kind of relative to I think the technology I looked the other day is 35%, right? Because some of those names we mentioned are in comm services. But if you would have put that back in there, that could probably been over 50%.
Yeah.
They wouldn't have done what they did before. So
Right.
again, it's just another way of things. So there's a lot to, think about there. I don't know. At some point in time, I think this goes back to a couple of episodes too that Kyle, you're talking about the opportunity for, again, with the show's name, stock pickers, right? If I think you need to be involved with these top 10 names or some or have a good sized weight there, but then that leaves a lot of opportunity in a lot of other companies that maybe
that haven't done so well.
They haven't done so well. Maybe they start accelerating their earnings growth reason because of a new product or whatever it is. So that if you can uncover that next gem that could double, that's I think you probably have a better opportunity of finding a double there than Nvidia as much as it's gone up. It's 8%. Can 8% go to 15% in the S&P?
Ooh.
Maybe. I don't know. I thought we'd have been tapping the brakes. But going back to your point on that, Lisa's, if you go back a year, expectations were for these large cap growth names to start decelerating the growth rate, still way above those non-top names. Those are supposed to go from like 25% down to low teens. What's happened here now, when it hit the mid-teens, it's actually re-accelerated back up, and I think that's why the latest move in those names, and vice versa, those names that were negative earnings growth rate, they were supposed to be 5, 10, or if they're not at 10 yet, they're still in high single digits. So the large cap, mega cap names have actually executed, and the other 490 some haven't as a whole. Doesn't mean that could change. I do think at some point in time that'll change. So I think that's worth noting. And then I'll switch gears here a little bit and kind of talk about some of the hot topics. We can't, avoid the fact that there's a government shutdown. We're recording right now on the 21st, so we're 3 weeks into it. Throw a few facts or numbers for you guys, and then you kind of give me your thoughts on. Obviously, our government crystal ball is probably as good as anybody else, but we'll at least throw some attempts at thoughts on potential impacts. But so there's been 22 shutdowns since 1976. On average, they last 8 days. And again, now we're in day 21, so we're well above average. The longest was in 18 and 19, which was 35 days. So this one looks like it, if I had to guess, over-under. I'll ask you two on over-under on 35 days. I'll start with Kyle before I get to some more facts. Do you think over or under on 35 days for the shutdown?
Another 2 weeks. I'm going to say over.
Well, okay. I like it. Lisa?
I
You always
say
like
under.
No, I'll break the tie. I'm going to go with Kyle. I think it's over. I don't know. Hopefully not much longer, but we'll see. It kind of be a little. It seems like a little bit of a stalemate right now, and I thought the catalyst potentially going into this week was at 15 days. We see more government employees that are furloughed / laid off, missing paychecks. I thought the government on both sides would say, hey,
it's enough.
It's enough. Let's get them their paycheck. Some people may have missed if they're paid mid-month, but it's not the way the cadence works. Most of them are paid in the military. That's one thing that I thought that would break the tie, but the military, they're essential. They're still working. They were not supposed to get paid, but they got some government funds changed around, so they are getting paid, but I don't know how long they can do that. So it's a little bit of a shell game of where the money's coming from. Historically, another reason the market hasn't cared, and so far it hasn't cared, is markets look through it. A, they're short, and B, when you're furloughed, you come back after 8 days, you actually get back pay. So now if you're missing paychecks, what are your guys' thoughts on potential impact on the economy and where we really start to feel it?
I don't know. I think I don't know if they will. Are they going to get paid?
We don't know yet.
This time?
I mean, historically they have.
Yeah, historically they have,
no,
but this
and
time it sounds like
There is like a little bit more other commentary that they might not receive back pay. And I think we saw that with ATC, for example, air traffic controllers, which they are still working, obviously. Otherwise, we would not be able to fly anymore, which is not undisrupted because major airports already have issues because they're already understaffed to begin with. And now with that they work without pay, and now with all the commentary that they might not receive back pay, a lot of them are calling in sick because it's like, so
sick
then,
out, yeah.
right. So it's like, and I think this is getting more and more the impacts of really how agencies and courts are not able to work. That I think this will probably, especially in air travel, and that was one of the reasons why it got resolved the last time, because there was Thanksgiving travel coming up, which is still out. But I think as there are more strains to it, there is more motivation to figure it out.
So now that begs the question: over or under on Thanksgiving?
Yeah, so how many days? I don't know.
I already said under, so for me, Thanksgiving
Yeah, no,
is out.
speaking of that, I traveled last weekend, and it's funny you mentioned the TSA, because my thoughts going to the airport, and we were in Nashville, which is supposedly one of the ones that were kind of having a little more issues. We didn't have any issues per se, but I know we're standing there, my wife's bag got checked, and then she was waiting, and it literally took like 15 minutes. I don't know what that was all about, but anyway, there was a couple of people complaining how long it was taking to get their bags checked, and it's just like, someone said to them, it's like, they're not getting paid and they're working, so it's, and they're like, oh,
So be grateful.
So, kind of, right?
Yeah.
Be grateful that they're doing their job, which is nice to see that. But at some point in time, that attitude would probably change too, right? If you drag over
And
a month.
especially when you have the commentary that you might not receive back pay as a
That's a game changer.
government. It's like, then you might not be, your attitudes to that might change.
I would think they would differentiate between TSA, who are working, and then somebody
who's not
between the back pay.
You would hope so. At least it's rational if you go down the order of pay.
Right.
It should be the
gets
person
it?
showing
Yeah,
up.
it'd be like credit holders, right? Like senior secured down to
Military, TSA,
Right,
post
right.
office, the one you consider essential that you're not paying their work, then maybe they get paid when they come back. And
Right.
maybe those other ones that not. I don't even like the term essential, non-essential. I don't know how that's really defined either. So that's one issue I have. And the other thing that I think is, I have a chart here on talks about the days that I think on the 24th, another 650 employees of the DOD are supposed to get a paycheck. So as the more and more people that are missing paychecks, and I think you go to 28th, it's entire agencies missing them. So then you're going to, the total number of federal employees, just keep this in perspective, is about 2 million. So our total workforce is about 163 million, I think. So the stats, it's a little less than 2%. So again, I think that's part of why, unfortunately, as cynical as some of us stock picker, market lookers, watchers are, is like, it's a relatively small bit of the economy. And you hopefully people have at least a couple weeks of pay saved up. But there's plenty that don't, because I was reading articles yesterday that someone's going to have
There's
to.
a lot of people who live paycheck to paycheck.
I mean, so it's like even one paycheck you're missing. You're either missing maybe your rent, or you pay your rent, and now all of a sudden you're not going to go to the movies or order pizza or whatever it is. So that eventually, even a small percentage could have a potential impact. And then I think, Lisa, you quoted the stat a while ago. Is it 0.1% of GDP drag
per week?
Per week.
Yeah.
That's a lot.
That's a
0.1
lot.
to 0.2.
So, and then we're on week 3, and I think the GDP forecasts have kind of been going up the last several months and quarters. It's gone from like 1.5 to, or 1.4 to, like, we're at 1.7 to, I think last one was 1.9. So maybe that starts going back towards 1.7, which 1 to 3 is healthy. So I'd rather be in that middle range than on the lower end. So it's something we have to keep an eye on. But are you guys, as analyst and portfolio manager, are you making any changes yet due to what's happening, or at what point in time will it be like a moment in time you say, oh my goodness, I need to rethink my whole thought process on how this could impact our portfolios and our outlook?
Yeah, I feel like this in general is a short-term issue. I think it would take a much longer structural change to want to make any rash decisions. I feel like, sometimes the hardest thing is doing nothing.
Oh, for sure. I've been doing this for 30 years, and that's like a lot of people are like, well, how come you're not making trades? Like, sometimes you're better off just sitting tight,
right,
and waiting for your thesis to play out.
Right.
I mean, it's not always the case.
Yeah, I mean, in fact, the way that portfolios get built, and I don't have to tell you guys, but in general, it is, thesis, risk, catalyst, long duration thinking. I'm not making trades for this week.
Yep.
So,
yeah, we're investors, not traders. We've made that pretty clear that there's an opportunity. You can make money both ways. It's a different acumen and different expertise and different risk tolerance and ability to. Most of our listeners and clients and advisors are dealing with pre-retired to retiree. So that's really not generally a place you want to have that much volatility or risk. So Lisa, you got any thoughts on kind of?
I mean, the markets seem to take it in stride so far. Markets are up. All major asset classes are up since October 1st, since the shutdown kind of started. That kind of is in kind of with prior shutdowns, majority of that, the markets were positive. But still, I mean, when we look at the economic reports, that's like a sore point because we still haven't received the jobs report. We know we have weakness there, so it's important that we get data. We haven't gotten data there.
That was October 3rd.
That
right?
was October 3rd. So we're missing that for 3 weeks
Yeah.
now. We fortunately enough, we get another inflation report this week. Usually it would have been Wednesday. Now it's Friday.
Is that officially coming?
Yes,
Because I've
Friday.
read both.
Yeah,
it is? Okay.
it's so the BLS confirmed that they will
Okay, good.
release it 2 days later, but nevertheless we get some data, and I think we're pretty starved of that. So I think the longer that would have gone on with nothing, then it gets a little bit iffy, right? Because if you really kind of sail your ship through whatever and you have absolutely no idea what's being thrown at your way, then it's getting messy over time, and especially when we think we have an interest rate decision next week. So it's good to see at least one part of the data, what they are looking at, not the jobs yet, but at least inflation data to kind of being able for investors to keep, make up their minds a little bit.
Yeah, the Fed, I forgot. I mean, I was talking to someone the other day, and I'm like, it's at the end of the month. I'm thinking that's 2 weeks away, but it's not. It's next week.
It's next week. Yeah.
It's crazy that time's going quick. And to your point that the farther you get away from the shutdown, the less data you get, I think inherently that's going to make things more volatile. So you'll get people, even if you want to sit tight, like, it feels like things are going softer. That's why I think we're in.
But the next thing is then, what are you going to do? Because if you have no data, it's like, yeah, that's bad.
Well, it is.
But what are you doing with that no
I could
data?
see
You have no
maybe to raise a little
basis and-
cash to kind of just
Yeah.
sit on the.
Well, I feel like on the data side, it is interesting because even though there's no quote unquote official data, it is interesting seeing some of the kind of alternative parallel data points come through. So you look at like Citi, you look at some of the private alternatives companies. Apollo has data on the inflation, jobs, that kind of stuff. So it is interesting seeing where the market is leaning into with the absence of, official data.
Yeah, I think the biggest thing for me is, not, again, to what you said, Kyle, of not doing anything. I think we're going to watch more of earnings. We're right in the middle. We had last week, I think, started off fairly positive in my mind.
good.
I mean, large cap banks always lead it off. There was a lot of good positive reports out there. Kyle, you can touch on that here in a second because you follow the financials more than anybody. I think they were good. I mean, there's some comments about maybe some private credits, some Jamie Dimon's comments where you see one cockroach there, maybe probably more. We'll see. But then you've seen Morgan Stanley, fantastic quarter. Goldman Sachs, great quarter. You've seen Citigroup, Bank of America, all they have a direct look on the consumer. So, any thoughts on financials?
Yeah,
just earnings so far in general.
Yeah, I mean, banks look pretty good. I think you laid the table nicely on that one. It is interesting the regionals though, because there was a little scare with Zion last week. But Key Corp looks really good. There's a lot of. I mean, you read through everything, and it's like net interest margins are growing, NII is improving, all the tier 1 capital ratios on the big banks, they're all looking great. Everything looks kind of in order and growing in a nice way. So there's not really any red flags to be concerned of in that spot. But this coming week, between now and Friday, it'll be, I think, a sixth of the companies reporting in the S&P 500. So that's a big chunk.
Yeah, and then you get this week, and I think the next 2 weeks from when we're broadcast is because then you get the other big tech names reporting next week, the good chunk of them. So I think you're going to see a lot, and I think that dictates how the year finishes. I mean, I still think all being said, we grind higher into year end, but I mean, if there's any hiccups along the way, we certainly been having a nice 2, almost 3 year run. So we'll see.
Well, I would say just to kind of close out on the earnings comments because what last quarter I did we touched on the podcast about kind of what earnings look like and the differentiation between large and small caps, and it is interesting watching it over the last 3 months develop because the small caps were under earning, not profitable, going from minus 10, 11, 12 on EPS growth to plus 40 on, kind of 2 year out. And those revisions have continued to climb. So every month, like every couple of weeks, it's like the numbers continue to tick up on those out year growth. So it is interesting to see because, we'll see if that trend continues or not. But I think it bodes well going forward.
Because we haven't seen a ton of, I guess, if there's no such thing as a marquee small cap name, right?
No.
'Cause that's the thesis, right? We haven't seen a ton of their earnings, or at least I haven't paid close enough attention to see if that trend's continuing. We'll see. I think generally speaking, their earnings season, the big guys usually are 2 to 3 weeks. Theirs usually stretches a little bit longer than that, just because there's some different reporting dates. Lisa, any thoughts on earnings? What you've seen so far, or
I mean, you
anything needing to
summarize it.
change?
You summarize it well with the banks. I think the large banks are still very much very much healthy, and they are traditionally the first ones. They're also closely looked because retailers are coming later, where we get a little bit more consumer information, and these are the first ones where we get a little glimpse of consumer spending, right, with credit cards and all of that. That remains healthy, which is important. Then trading and investment banking fees are picking up again, so they are very healthy, well capitalized, enough cash on hand, so that's good. And on the regional, we had the flop with the commercial loan frauds that a lot of them took losses of.
Yep.
And I think with investors, I mean, the last big crisis was the great financial crisis, right? And it's still kind of the majority of investors still have that in their bones, I think. And whenever we hear something about banks and credit quality, whatever it is, it's kind of, there's the fear back and a little shudder back.
When you had the regional financial crisis, you had SVB, Signature Bank.
We had that in 2022. 2023. Yeah, March
March
2023.
of
Yeah, right. It was right the day when I started working here. So
Was it?
There's a fun note.
That coincides with your.
Yeah,
All right.
exactly. But so that always kind of, does not do well for the market if something like that happens. But I think it's important to know that big banks are well capitalized. Their debt to deposit ratios are fine. Their loan losses are very low. So we're nowhere near any crisis here. But we see some spots where, there might have been some wrong decisions that were made, some fraud that was taking place. And I think, so while the overall banking sector, what I actually wanted to say, is healthy and remains healthy and is nowhere near crisis, I think the shadow banking system needs maybe a little bit more focus on, like all the, business development companies and all of that. And since the great financial crisis, there's a lot of stringent disclosures and regulations that got more and more over the years for banks, how they kind of give out loans and how they have to disclose and how capitalized they have to be for us to avoid another crisis like that. On the other side, like business development companies, a lot of private credit,
No, you don't know.
do not have to disclose all of that. They are not under the same regulations, but do some of the same stuff, right? And they kind of stepped in when the large banks were not able to do this anymore because of regulations. So I think there is some risk there that needs to be observed or maybe more closely watched. Like Jamie Dimon said, if there's one cockroach, and he referred to private credit, there is probably more. There could be, yes, because there's so much we do not know and so much that is going on there when it comes to disclosures and regulations, like I said, that maybe there needs to be a little bit more close attention to that going forward, I believe. I don't know if I overestimate that risk, but I think that is a risk that needs to be
for sure.
addressed.
Yeah, financial system, you need a sound. That's
Right.
Doing this for.
And while the
kinda
public financial system is fine, if the other one is falling apart, that
could
pretty much grew over the last decades.
it could cause some unintended
Exactly.
consequences, and bank lending standards tighten up again or something like that. That could slow the economy down. So certainly worth keeping an eye on. So All right, we'll finish on one last question. We can just kind of keep that one short. So obviously we talked about earnings and government shutdown. So what are you, for you two? What's a key? Do you think that obviously those two are important? What's the next key kind of issue or thing you're watching? Is it something that's could dictate some next near-term direction of the market? Is it something to do with China or jobs or no data or what's your Lisa? What's your big kind of thing you're watching besides earnings season?
Well, we saw last week with kind of new China tariff announcements, and tariffs were a little bit on the back burner so far. We have a lot going on right now that investors can be concerned about. Tariffs did not seem to be one topic of that lately. And then we saw how the market reacted with the sharpest move since April when the administration announced new potential 100% tariffs on China. And then we saw, oh, this is still a thing that we have to look at, right? It's still ruffled some feathers if there's some news surrounding that. So I think that maybe needs a little bit more attention, how China and the U.S. trade relations are going, which now the commentary is a little bit more tamed again, but there's still no final deal, if there ever will be. So I think that showed us, and even though if investors were able to look through that quite, fast, but I think that still is a risk out there that we should not put completely on the back burner as of now.
Kyle?
Yeah, I would say that the two, I would agree with that. It is interesting, the reaction. Tyler would say, this frequently, and that's like the markets are priced for perfection right now. And any little bit, we talked about this a lot over the last 6 months, where companies that beat during earnings season, not really rewarded. Companies that miss are punished heavily. And I think that same logic applies to tariffs or tweets or whatever, but I can't really control that. It's hard to be able to, insulate your portfolio against those tail risks. That being said, the things that I'm keenly watching and trying to figure out what that looks like is inflation and the labor market. So it is interesting to look at. There was a piece I was reading earlier from Goldman talking about labor market revisions, even though the data is a little sparse right now. The trends from the kind of beginning of the year, January, it was like 125,000 run rate, and now it's like a 30,000 run rate.
Big
And
difference.
the three key items that they note are basically reduction in immigration was 50 to 60,000 per month. Reduction in federal and state kind of government employees, that was 30 to 40,000, and then potential impacts for like efficiencies, so AI adoption and white collar jobs. So that makes up that 100,000 kind of block of
Delta down.
yeah, delta down. So question is like, is that actually true or not? And if it is, it does make me think about like the quality of, like, if that's actually what's just driving the labor numbers over the last few years, is just those few items. I'm like, oh, it is interesting to think about and how that actually impacts the companies in a portfolio.
Yeah. No, that's well said. I agree with both those 2 points. I would say, Lisa, I think tariffs is probably the one that to me it's like it's not there, it's there. I think regardless of what happens, I think 2025 we'll look at in 10 years from now, it'll be the year of the tariff. And that's good or bad. We may, so far remember, Liberation Day was just a mess for a month, and then markets realized maybe they're not so bad. So we'll see what happens in.
And by mess, you mean buying opportunity.
Yeah, by a buying opportunity for sure. The pullbacks, equal buying opportunities. And that's certainly what April presented, and that's what happened. But again, you didn't know. I mean, some people were saying it's the economic chaos versus art of the deal, and I think now more people are on art of the deal. But what happens on tariffs if they're illegal and there's no workaround?
Right,
and
that is another thing.
Thing besides just the China tariff stuff. It's like the legality that no one's even really talking about. So I think that could be a fall surprise and potential market event, but then usually, again, those are usually buying opportunities if that causes a pullback. So we'll see. So those are our thoughts. Thanks, everybody, for listening, and like and subscribe.